Hey everyone, in this video I'm going to highlight one growth stock that's down almost 68% off its high that I think you might regret not getting it on this dip. But before I tell you what this company is, let me talk about its financial metrics and then I'll reveal the company name towards the end of the video. So let's get started with the company's revenue. Now what I have here is a chart of its trailing 12-month revenue. And what you could see is over the last 4 or 5 years or so, this company's revenue has grown explosively from close to $3 billion up all the way to 10.5 billion in the most recent update. And the industry it operates in, this is an e-commerce company, it's likely to continue growing over the next several years. In the near term, consumers are spending more money away from home. They are unleashing this pent up demand to get out of the house because we were cooped up at home for so long. But longer term, I expect consumer behavior to return to normal levels and return to normal trend lines that were existent before the outbreak. So, in the long run, overall spending, the percentage of overall spending, it's more likely to shift online. It's just so much more convenient. Brick and mortar has so much more difficulty competing against this. So I think the trend line for this company is likely to return to very healthy growth in the long run. Additionally, another reason why I really like this stock and I think you might regret missing out on it is management has done an excellent job delivering economies of scale. What I have here is a chart of this company's cash flow from operations to sales. And what you could see is as its revenue has grown over the years, so has its cash flow from operations to sales. Management is doing a good job turning increasing sales into increasing cash flow, and that's not an easy thing to do. I see a lot of growth stocks that are increasing revenue, but that's just leading to more losses on the bottom line. That's not the case for this growth stock. It's doing a good job using growth in revenue to expand profitability, to expand cash flow, and I like to see that a great deal. And the last reason I'll give why you might regret missing out on this growth stock is the valuation. This stock is trading at a forward price to earnings of 55, which is on the lower end of where it has traded for in the last couple of years. Investors have had few opportunities to get this stock at lower valuation. One around May of 2022 when it was trading at valuations closer to a forward PE of 40. And around June of this year, you had an opportunity to get this stock again at a forward PE of around 40. But besides those two opportunities, you haven't had a chance to get this stock at a cheaper valuation. And that's just because the market has seen and observed what this company is capable of, and they're quick to get in and jump in on this stock when the valuation gets cheap. So for that reason, and all of the reasons I mentioned earlier, I think you might regret not getting in on this growth stock here. So what is this company? This is Chewy, ticker symbol CHWY, the e-commerce pet retailer operating in this $100 billion market opportunity, and it's doing a good job so far. All right, for those reasons, I think you might regret not getting in on this excellent growth stock. All right, but that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.